So today will be fun. We are going to look at a comment on my video from yesterday, a fictional story of Sarah, an early Apple investor. So the comment was that, my argument was that Tesla might be like Apple in 2007. Tesla, the company. In 2007, Apple was already a big company. That, by market cap, it was number 33 or so. It was one third of the by market cap, one third of the biggest company, ExxonMobil also. Like already a big company, right? Tesla already today is already a big company. But then they announced the iPhone, and this basically made them the biggest company and created this, say, 30x run or so on the stock price in only 17 years. And I told the tale of Sarah, an early Apple investor. She bought shares when she heard about this announcement and then simply put like a small amount of money, 6K or so per year, into the stock, and she became a millionaire in only 17 years based on her steady investment in this growth story. And I said, okay, there might be an argument for the humanoid robot being the same for Tesla, right? The humanoid robot. So this is basically here the chart. This is a portfolio of Sarah. Over time, you can see how it exploded to 1.7 million, basically. So now we have the humanoid robot. Tesla announced this 1 or 2 years ago already, and they have already the product, right? They have already humanoids working in factories. There's a lot of external confirmation as well, like NVIDIA is entering the humanoid robotics scene. Many other companies already produce and some even sell humanoid robots. So it is like for sure this product is coming, and this product category will be as successful as a smartphone, is basically my thesis, right? And not only my thesis, it's kind of an obvious thesis in my opinion, right? If you look at the product has such an insane value for the normal person, and also for the, say, company owner who can actually use those humanoid robots, deploy them in factories to create value instantly. Not only in factories, also in offices and so on. The great thing about the humanoid form factor is that you can put them into any environment that is optimized for humans. So it perfectly, it's like an API that works perfectly with the human environment, right? So we can connect the digital world with our physical space without changing our physical space. So we basically adapt the form factor in a way that can be integrated nicely in our human world. And so we will digitize everything, right? In a way, we will have, each one of us will have a bot at home. We will have bots in factories. We will have bots in so on the streets, maybe for security reasons. We will have bots in elderly care, and so if I'm old, I want to be I want to have such a thing for sure, right? Because it's just like it can do a better job without judgment, right? Without human judgment. So it's in some cases it's basically more ethical in a way to use robots than to use humans for some tasks. And also these tasks can be done cheaper and more precise over time, better tasks. And human labor is just very human manual labor will look like a very strange idea in, say, a couple of decades from now, right? It's like using horsepower or so to power anything really today. You would think that there's a better option for this, right? And I think it will be the same for human manual labor. Okay, whatever. The idea is obvious, and but I got this comment. I am also a Tesla investor who has its gain of over 1,100%, like Sarah. I was also an early investor of Tesla, but not at this high of a valuation. I'm not adding any Tesla shares because the valuation doesn't make sense. Okay, so we get this valuation critics, and I responded that that this sounds like the exact argument somebody would use against Apple stock in 2007. Like in 2007, there were already people making 1,100% gains on Apple, like this guy, based on the Macintosh computer investment thesis or the iPod. And like Pronciado 7184 also made 1,100% gain, but not on the robotics story, not on the AI story, but on the EV, electric vehicle story. But this one is another story, right? And he basically anchored his valuation on the past story. And he like this is making the same mistake as anchoring the valuation of the Apple company based on the past Macintosh and iPod story, when in fact they created the iPhone, which turned out to become a product used by billions. And many people in 2007 already saw this, right, and became rich. Okay, so this is like one of the major points I want to make in this video, that XYZ is overvalued should not be a reason for you to stop thinking about the opportunity, because oftentimes the opportunity lies in those things that are considered overvalued by, say, the hive mind, the common person. They just throw you, this is overvalued in your head, and telling you that you are stupid or naive because you believe that something is valuable. They just tell you it's overvalued and sound smart, smart in the process, but will be proven wrong by reality, right? So it's like this simplified graph here. We have the value over time, and you see, like, if we go from one state, like a state before iPhone, to another state, like where most people have iPhones, we have this insane growth curve. But it doesn't look like this. It basically looks like this, right? So we have some fluctuations of the stock price of the company, and oftentimes the market also anticipates a certain growth. So in reality, it might, like, the anticipation might look like this, right? But anyways, even if you buy at this, say, overvalued or overhyped point in time, or at this time, or at this time, it is always a good buy if you are really at a phase change transition. So you go from this phase to this phase, right? So you have a phase change in physics or in systems theory. You basically have you change the stable state in a way. You have a foundational technological breakthrough, for instance, or an invention, and this invention will move society from one state to the other state, and the transition will be brutal, it will be volatile, it will be unpredictable in a way, but sometimes all we need to do is to anticipate the other change, the other steady state, like, for instance, the state where we have billions of humanoids, and then just take our bets accordingly, right? And not caring too much about the little day-to-day volatility here in this transition. There was another comment in the video. This one, it's not about early or not. The thing is that Tesla is priced too high. Don't persuade people to invest. Okay, what is this? Yeah, to invest in Tesla at this high is impossible. Okay, so this is like difficult grammar, but it's basically the same argument that those who believe in Apple is like Tesla, but the valuation of Apple that time in 2007 was very small. It wasn't 700 billion like Tesla is today. And so it cannot be compared to Apple and so on, because Tesla is higher valued today. I think, so I made three counter arguments. First of all, Apple in 2007 was not a small company. Its market cap was between 75 billion and 150 billion. And the biggest company at that time was only 500 billion, right? So Apple was 1/3 of the biggest company already. Apple was already a major player, major big company, highly valued. And Tesla today is less than 1/3 compared to Apple now, right? So it's basically in a similar state. we must think relatively, right? So the argument that Apple was very small in 2007 compared to Tesla in 2024 must be rejected. Why? Because the world has changed, and our reference point must change as well. Also, the second argument I made is the reason that today's large companies are almost 10 times higher valued than 2007's large companies is, first, we had significant dollar debasement, so by roughly 7 to 10% per year. And second, we can now reach more scale through technology, right? So the companies can become bigger. It is actually possible to create bigger companies with larger scale. So both arguments hold for AI and humanoid robot industries as well. Then thirdly, the argument that Tesla's overvalued basically wouldn't hold if Tesla in fact produced $1 trillion in profit, like I did a simple napkin math valuation in the video, right? And if this future actually turned out to be true, that Tesla sold 100 million bots and 10K a piece, made 10K profit per unit, then this argument would be wrong to argue that Tesla is overvalued today, because in fact it would be undervalued, right? It would look like this. It would look like purchasing the stock here somewhere, right? Before the phase change transition happened. So the argument then would have to be rejected. And we can already reject it today if we believe in the story. So the argument builds entirely on the thesis that this won't manifest, right? And so either we don't sell 100 million units in the future, or we don't profit 10K per unit. But if both those arguments or those assumptions are true, then Tesla is not overvalued today. And it's like with the Apple in 2007 scenario, where somebody wouldn't believe that 100 million people will buy a smartphone eventually. And I mean, you can take this position, but I think this position will turn out to be on the wrong side of history, right? because it's just reality will prove them wrong. This is just my opinion. Sorry. So sorry, I just had to take a call. Okay, let's go back to the argument. Okay, so if we, we can take this position that this will not manifest, but then obviously we, if we are wrong, we are not making the gains, right? And if we are right, we are making huge gains, like significant gains. And for instance, now I want to also support my argument that this overvaluation counter argument is often very stupid, very shallow argument that can be issued very quickly, and that is made by people who have not thought deeply about the stock. Oftentimes they just reject it for themselves. They reject the opportunity by making this argument. So everybody rejecting the opportunity is making this same argument. It is overvalued, and sometimes they are right. Obviously, I'm not saying that this argument is generally saying something is overvalued is a bad thing, right? But if you have found an opportunity that you believe in, then people will make this argument, and in order to stay, everybody who stayed on this opportunity in hindsight was pushing through this argument, was ignoring this argument for a long period of time. Otherwise they wouldn't have stayed in this position, right? And here we see the Amazon stock price. It has in 1999 it was $3.30, $3.50, $5 at the height of the 2000 stock bubble, so to say. So even if you bought at the height, it was a very steal, and then it crashed to $0.75. All of this is split adjusted, obviously, but relatively. So it crashed significantly. But everything in 2000, the stock was priced at $1 roughly, right? And then it gradually rose again, $2, 40, $6, $11, $22. All of this time, people were actually arguing that Amazon is overvalued. So I did some research. For instance, here we had in May 99, Barron's published an article titled "Amazon.bomb, predicting Amazon's collapse," right? And in Jim Cramer on Mad Money in 2004 expressed concern that Amazon was overvalued, right? In 2004, imagine that. So we have 2004 here at $1.50, and you listen to those people just quickly arguing from very shallowly, from making the very shallow argument from an earnings call or so, point perspective, that the stock is overvalued at $1.60, right? Today it's 100 times that. So you could make 100x gain if you ignored this advice. And let's go back here. And here we had in 2008, in the financial crisis, many believed Amazon was overvalued. The share price, so in 2008, was here like $2 or something, right? $1. It didn't even crash a lot in 2009. So it was roughly $3 per share in 2008. So we have David Einhorn, a hedge fund manager. He questioned Amazon's valuation in 2011. In 2011, we had $6 per share. So we could still make a 30x or so on our investment in 2011. And all of these are like very convincing people. Scott Galloway, maybe you know him, New York University professor Scott Galloway. He frequently criticized Amazon's valuation. He argued that the stock price was unrealistic. In 2017, for instance, and even before 2017, here stock price was $40 or so. So you could still make a 4x in 7 years, which is great gain, right? Charlie Munger oftentimes criticized the valuation of Amazon, for instance, in 2018, but I think also before. So here at say $66 or $70, he criticized the valuation. You could make a 2x in only 3-4 years, which is also a great return on investment, right? And but you get the point. Many people, even very credible people, argue that stocks are overvalued. But what happens in reality is a phase change transition. So if you see this phase change transition, it must trump these kind of little arguments of overvaluation based on some factors that could not, like some say short-term factors, like for instance the PE ratio. So it's often a short-term factor. If it was that simple to avoid high PE ratio stocks and make huge gains, then everybody would be rich, right? But it's not like the PE ratio doesn't predict kind of the performance of a stock, right? If it is not like those people arguing that a stock is overvalued often refer to the PE ratio. But even if a stock has a PE ratio of 100, but it grows at 50% per year or so, like NVIDIA or Tesla in many instances, or Amazon in many instances, here in the past, at this point in time, Amazon actually had a very high PE ratio, right? Because it was growing fast. So you could not reject the stock only for the reason that it has a high PE ratio, right? It had a high PE ratio in 2016. It had a high PE ratio in 2012. But it grew into this valuation, and so that's why the argument of the stock having a high PE ratio, it is not enough to reject a position if you believe in the fundamental transition behind the stock. Similar, Tesla was labeled as overvalued for a long period of time in 2013, in 2018. Many analysts arguing it was overvalued. Many people, like Tesla, was like attacked all the years over the years here, going from $1 per share split adjusted to 100 to $200 per share, like a 200x in the position in not since 2007 but since 2010. So in a very short period of time, in 14 years, it made like a 200x or so. It was criticized so many times for being overvalued. The PE ratio was always high, but this is a phase change transition that happened from non-electric vehicle to electric vehicle, and the position the valuation we have today is mainly based on vehicles, right? So electric vehicles, growth of vehicles, vehicle sales, and so on. and maybe a little bit on full self-driving, the market maybe accepts that Tesla will have a higher margin due to the sale of some software in their vehicles, but not more, right? It is not based on robotaxi valuation. The market doesn't add a lot of value for the robotaxi story, and the market doesn't add any value at all for the humanoid robot story. Why do I know? How do I know this? I mean, the market maybe adds a buck or two or so of this valuation is maybe the humanoid robot, so a little bit of valuation will be baked into this price, but it's very little, because if you actually do the math, you would see that that even if you have a probability of 10 or 20% of the humanoid robot, the stock price would have to be double of the stock price today, right? But I would say the probability that we will see humanoid robots is like in 10 years or so, it's more like 95%. But the market obviously doesn't agree with me in this. Otherwise, Tesla would be valued far higher. So I would say we will see for sure humanoid robots, and Tesla, it's very likely that they will be a main player, maybe still the leading player. And if both of those are right, then Tesla should be valued far higher because of this valuation I gave in yesterday's video, this simple napkin math. If we have, say, a 90% probability that humanoid bots are coming in this decade, and we see, say, a 50% probability even that Tesla will be one of the major players in this space, then Tesla will sell tens of millions or even 100 million units per year, and making the profit means that it will earn trillions, right, in profit, at least hundreds of billions, with a probability that is like 50% of 90%, so 45% of 40%, so with a significant probability, right? And if you calculate the expected value, so we have 40% probability on like even 500 billion earnings or so, would mean 200 billion earnings, or a stock price, or a market cap of 4 trillion at least, right? And this is just the expected probability. So the expected probability should already be like, so the market cap, if you would actually believe this story, should be 4 trillion. But of course, this is the opportunity, right? I mean, it could be wrong, the probabilities could be wrong. Maybe Tesla doesn't make it as one of the leading companies in the space. Okay, I gave some, in the other Finxter videos, I gave some valuation about Tesla, about NVIDIA, so you can check out my other videos on the Finxter channel. Also give me a like and subscribe to the channel if you like those type of videos about the future potential. The main idea I want to deliver in this video, once again, so I love to make it explicit, is that very credible people will tell you that your stock is overvalued. And if you repeat, like, if you have this fictional story of Sarah making 1.7 million Apple portfolio over a short period of time during work, so she invests like a small portion of her income into the story, into the stock that she believes in, Apple. There were a lot of people telling her Apple is overvalued. Today there are fewer people because Apple has just proved them wrong over the decades, right? And but that's why Apple is not the big story anymore, right? That's why I don't see, like, no investment advice in this video. Nothing I say is investment advice, but it's just my personal opinion. I think like Apple is an interesting bet. I mean, it will grow probably further. I think it will be a good investment with probably a higher return on investment than the S&P 500. But it's a pretty safe player. Everybody already agrees with you. But most people don't agree with the humanoid robot story. They don't agree, or they don't get it. They don't get the opportunity. That's why Tesla, for instance, in my opinion, in my view, is significantly undervalued, because like the market assigns almost a zero probability to this phase change transition, going from no humanoid robots to billions of humanoid robots. And if we really see this transition unfold during the next 10 to 20 years, then Tesla is likely to appreciate significantly from this point in time into the future. There will be volatility, and on the way up, people will always tell you the same argument: Tesla is overvalued based on some PE ratio or so. And the market will continue to prove them wrong until Tesla will be the biggest company and everybody will agree with your story, and the humanoid robot story has played out. And then it will be difficult to keep growing maybe for Tesla, right? Because for Apple, for instance, it's also difficult to grow their revenue from smartphone sales. The market is already saturated at this point. Okay, but of course, again, I could be wrong with this thesis. I could be wrong, and I could lose money. I don't put all my money into Tesla stock. For that reason, there are other great investments at this point in time in 2024. This is not investment advice. You should do your own research. I just share like some first principles arguments, and I just wanted to react to the comment I got on yesterday's video that Tesla is more overvalued than Apple in 2007. I don't think so. This is like a failure in reference point failure. Apple was already a big company. Apple was already, say, overvalued in 2007 from those like using similar metrics like PE ratios and stuff. The most important thing was that they had a new product. They created a new product category and believed in this category, and the category then reached 1 billion people. And if you sell a product, nobody could believe that Apple would eventually become a $3 trillion company. People argued from the 500 billion market cap perspective. They thought, okay, yeah, if Apple becomes the biggest company on the planet, maybe they do a 3x or so. So they completely, because they were anchored on the size of the biggest company, which at this point in time in 2007 was like ExxonMobil at 500 billion or so. So they thought 500 billion is the highest market cap a company can ever have. But now we are almost 10x that in only 17 years, right? And I believe we will 10x that in another 17 years. So we will see market caps of 10 trillion, 20 trillion or so in the not too distant future. Okay, thanks for listening. Give me a like and subscribe, and see you in the next video. Bye.